LP Perspectives, Tapping Diverse Capital Sources to Drive India's Climate Story, explores how diverse LPs and asset owners are driving climate investing in India and what it will take to unlock the larger long-term pools of capital. We'll hear what's missing, what's working, and how India can position itself in a global climate investment destination. Inviting our panel on stage, Ms. Nishtha Chopra, Investment Manager, Private Equity Funds and Co-Investments at British International Investment, Mr. Shalabh Tandon, South Asia Regional Head of Operations and Climate Change at International Finance Corporation, World Bank Group, Mr. Arvind Kodikal, Regional Manager Equity, Asia Pacific at Triple Jump, and Mr. Kaushik Rajagopalan, Director at Impact Fund, Denmark. And moderating this panel is Ms. Richa Natarajan, co-founder and partner of UC Empower and member of IIC Executive Council. Over to you, Richa.
Thanks, Mala. This is pre-lunch, so it's nice to still see people here, but hopefully everyone's awake and we'll try to make this interesting. And this is the opportunity for all the GPs in the room to ask all the LPs the difficult questions they want. So please take control of that opportunity. Maybe I'll just start by asking a few questions that I had in mind for these GPs, for these LPs that we've been talking to for a long time. And Arvind, we'll start with you. You've been investing across India, Africa, a bunch of other geographies right now. How do you compare India to other emerging markets when you look at it from an LP's perspective? And are you bullish on India, even now?
Hi, yeah. Thanks for the question. So I work with the Dutch Good Growth Fund and also advise Axion International, so doing both directs as well as fund investments. And within funds, DGF has a mandate to look at first-time managers, and there's a very big climate agenda that the fund has. So India, vis-a-vis other markets, I think overall we've been very bullish for the past many years. We've backed funds like Anchor Capital that have been on the forefront of agriculture, but also at the intersection of agriculture and climate. We've backed Omnivore, we've backed C4D, and we see even now with all the push that's coming in from the government on the renewable energy side, that climate represents a very, very big opportunity in the market. In terms of so the opportunity and scalability aspects are very high, but in terms of the risks, there are two that I'd like to mention. The first one is really around life cycle. So we see that there is a lot of the two big gaps that we see are on the incubation side, where we need more patient capital. Then on the venture side, where a lot of impact capital can actually come into normal fund structures. There are a good amount of funds that exist. And then on the private equity side as well, we see that there's a bit of a gap which needs to be filled, so that companies can actually move through the entire life cycle, right? So that's one area where we struggle with. And increasingly, as we look at a lot of innovative and deep tech models that have to come in to solve the problems and the challenges that we have, you are going to need people to play at the early end of the spectrum. So that's one. The second thing is that corporate governance across India, but also Southeast Asia, has been a bit of a challenge. But I guess this is not something that's limited to the climate sector. It's across the board. So we hope that we as DFIs and the funds that we invest in can play a very active role to mitigate the challenges across CG that we are seeing.
Thanks, Arvind. I'll hold you to that for one more second. You brought up two important risks. One was on the governance side, and we've seen a lot happen over the last couple of years. What are you doing to help managers? Because there's a lot of onus on managers to be able to manage governance at their portfolio companies, and when you have a portfolio that's 20, 30, 40 companies, becomes hard. So just, some advice or things that you've seen work well, maybe on the governance side. And second, you talked about deep tech, and we talked about this a little bit earlier. Are you looking to set up vehicles or work with managers on that front to be able to accelerate more deep tech capital and innovations into India?
Sure. So I'll take the second part first. It is a bit difficult with the structures that we have in place for us to put vehicles or, we're open to thinking creatively. Within DGIF, for example, there is a seed capital and business development practice which exists. But the quantum of capital that's required to be able to move the needle, I think requires support from the apex institutions within India. I think they are in the best possible position to make a deep impact over here. We are happy to play a catalytic role if required, but I think we are perhaps not in the best possible position to support over here. Now, on the corporate governance side, listen, this has been a challenge. It's a challenge even in the US if you look at it. What we keep telling our GPs is that you have to be direct and involved. Increasingly, I think across our portfolio, we are starting to see this risk mitigation by not being part of the board, being part of the observers or advisory. So what we keep telling our funds is that we like to see more active involvement rather than risk mitigation from your side, because that's the only way that you can know what's happening in the companies and be on top. There are also a lot of trainings models that are available, and within the DGF now what we are going to look at is what the DFIs do really well. I also sit on a board for FMO, the Dutch Development Bank, and we have a gathering once every 2 years where we can discuss actively about the issues that we've had in our portfolios, how did we deal with those. So I think a lot of learning and sharing forums and safe spaces have to be created so that the early warning signals can be picked up in a better way. And hopefully that also gives us some tools to manage the crises or the upcoming issues. And finally, I think with the liquidity in the markets changing, hopefully, incentives will also get a bit more aligned, because the markets also went a bit crazy, and CG gets affected as a result of it. But these are my views, of course.
I think just coming in on that, and you raise a very important point on governance, and we have seen cracks in the system, we have seen issues come up. And like Arvind said, I think as LPs, given the breadth that we see, we do have quite a few trainings for our fund managers to kind of help them think through and kind of learn from the mistakes that have been made in the past. So we do have workshops and trainings to actually help them, which some of our funds do benefit from. So I think as LPs, given the experience that we've had in the ecosystem, it's important to kind of bring that forward and have lessons learned, etc., for everybody. Thanks.
Thanks, Nishtha. And just maybe taking that line of thought forward a little bit more, what do you look for in GPs, especially maybe emerging GPs, but also the more established managers that give you that confidence and help you build, credibility within your system that this is the GP I want to back initially, but also want to continue to back?
Yeah, absolutely. So look, I think commercial returns is paramount. Without that, there is no, that's the conversation starter, right? You can be as institutionalized as you want to be and very, like a strong platform. But if the returns aren't there, then it'll be very difficult for whether it's DFIs or any capital allocators to really look at funds, whether emerging or established funds. So I think that's key. And through that process of diligence, I think the key pieces that we really look at are the team size compared to the fund size and the portfolio that you will be managing, whether that's commensurate or not, whether some of the reporting that was talked about even in the previous session by some of the GPs, given our focus on not just financial returns but impact also, we have a fair few requirements for ESG, impact, quarterly reporting. So to ensure that we as DFIs will get what we require from the teams without them being overburdened and almost losing sight of what the bread and butter is, which is investing and divesting from these companies to ensure returns.
If I can add to what Nishta said, from an IFC perspective, when we look at investing in a fund, it has to meet 4 clear criteria. One is it should complement our direct investing. So if there's something we can do directly, it begs the question, why are we investing through the fund? So they have to do something and create certain impacts which we are not able to reach by investing directly. That's number one. Number two, obviously commercial returns, as Nishta said. That's paramount. No investor would invest in a sinking ship or where you are losing returns. Third is, for a very important reason, the role and additionality of a DFI is very critical in a fund manager when we invest in a fund. Is there really a role that DFIs are playing? Are they able to raise capital easily from the market? So is there a financial role, maybe where we come in as anchor investors to help them raise money, or a non-financial role, which you talked about, ESG, climate, other metrics, advisory, etc. So that's third. And more importantly, fourth, that's becoming more and more important right now, is to have clear metrics around the impact that they are creating on the ground. Whether some people call themselves impact funds, some call themselves do not label themselves as impact fund, but whatever way you call it, for a DFI or at the end of the day, we want to see tangible impact on the ground. And impact doesn't mean only social impact, it can be any other form. So we force that conversation early on when we discuss with GPs, and that focuses a lot of discussion around that. And then finally, a cutting theme across commercial returns is exit strategy. We want to force a discussion around portfolio construction and exit strategy right in the first conversation. Obviously, everyone will say in India we'll IPO, and IPO, we all know what the bull market is in India, or we'll do trade, sale, or strategy. Those are very cookie-cutter answers. We want to see real thinking behind an exit strategy in portfolio construction.
I think maybe just adding to that point, particularly in climate also, there are various risks. I mean, we're at a climate conference right now. It's a very, the market is very vibrant, particularly on the early stage side, I would say, and much more mature than it is in the growth PE side, anything between, I would say, the larger tickets really. You don't have too many players focused on purely climate, right? So I think that is very important. But yeah, let me stop there.
It's okay. And on that, Nishta, we have funds that are sector specialists, so climate funds that have come up, but we also have generalist funds that are also doing climate. What has been your experience in terms of performance, both on financial returns and impact, that they have been able to create? And do you have a preference for one over the other?
So I think historically speaking, we have seen strong returns from a lot of sector-focused managers, particularly the financial services managers. But saying that, I think generalist managers and the returns there are picking up. I would caveat that by saying that a lot of our generalist managers also have large FS portfolios, which do drive returns, I have to say. I wouldn't say we have a preference for either, we do both. And it begs the question of, where do you really need a sector specialist? I think sector specialists bring a lot of expertise, which is critical to certain sectors because they really understand, the nuances of what are the risks, what can we do to mitigate these risks. But I think what is very important is they really understand the entire value chain and where the opportunities are emerging, and to be able to back these companies early on, which is really what they do and what they excel in. So I think it's across the board. We are seeing a lot of our generalist managers also delve into climate and starting to kind of dabble with it, which is promising. But I think the growth PE sector, and I'll only speak for that because that's what I look at, is kind of gaining that traction. Like I said, VC is still much more evolved.
So very quickly, I want to comment on this because IFC has invested in about 70 odd funds in India. So we have a huge lessons of experience here. And let me talk about the vintage. You asked sector funds versus non-sector. In the early 2000s, our experience was that the sector funds had not performed well. They were not giving us the return that we wanted. And Kaushik knows this well from his IFC days. Some of the infrastructure-focused funds that we invested in barely gave any returns. But now the scenario has changed. And so we are looking more at as a hybrid approach. And by hybrid approach, I mean, yes, you should have a focus, let's say a climate-focused fund or a particular sector-focused fund, but it should not be so narrow and boxed in that your returns may suffer. Tomorrow a new opportunity comes up. Just because you are boxed into a particular sector, you might miss it. So it should be broad enough, or it should be hybrid enough so that the fund managers are nimble to see the opportunities on the ground and can pivot if something is not working.
I think it's a great.
Maybe I'll just add to that, right? So I used to work with Shalabh for long years. But back in the day, obviously, I mean, as Shalabh was saying, that earlier, the generalist funds were doing fairly okay. But one of the things I realized, which has evolved over time, is that funds really need to start adding value now, and you need sector specialists now, right? And therefore, at least our focus at the Danish DFI, which I'm a part of, has been to narrow down and focus on sector-specific fund managers, and more importantly, have a team within the GP which has actually worked on the ground, right? And I think it makes a huge difference as opposed to having generic guys who are just essentially dishing out term sheets, as opposed to guys who actually worked on the ground, spent years, right, putting up projects, and working with the government and so on. So I think there's going to be a clear focus going forward. End of the day, you have to be better than LLM going forward, and you can't be better. I mean, at the end of the day, I view at least generalist VCs as more of ChatGPT extensions, right? So we need to go beyond that, and I think you need people who have built businesses, who have at least worked on the ground. So that's my little view on this.
No, that's super interesting because, like you said, I think a decade or two ago we wouldn't see operators come in to actually build out investment institutions, and we're seeing more and more of that. And certainly that is what is needed in climate. And at least the investment teams are beginning to bring in, whether it's venture partners or advisory boards, etc., to help complement that and fill those gaps when you're a little bit more generalist. Do you think that's sufficient or no?
I mean, not really. I can speak from my own experience, right? So the thing is, I used to be at IFC for about 6 odd years, and then I worked with an operator on the ground for about 3 years, and then back on the investment side. So the thing is, first of all, it makes you a bit more humble, right? The thing is when you actually realize how difficult life is to set up a company in this country, right? And actually to scale it up even slightly, right? Even to get one project off the ground, it's such a arduous exercise. You actually become a lot more humble and a lot more understanding of what the issues that they're facing. And therefore, the approach that you take is a lot more nuanced, right? As opposed to being a very blunt sort of a strategy. The second thing also is that you also start understanding what the value drivers are, right? Where do you cut costs? Where can you actually make some money? Where can you skim the market, right? These things are only become obvious when you actually work on the ground, right? As opposed to, and currently I do that. I do kind of dish out term sheets and so on and so forth. But it comes from a realization that, I've been there and I exactly know what it takes to some extent at least to build a reasonably successful enterprise. So.
No, that's helpful. And given the vantage point that you have, Kaushik, are you seeing that it is genuinely possible to build companies in India using this whole Make in India narrative, but really grow it and make it a global business? Do you see that actually happening, or is it just a lot of talk and very, very little actual execution on the ground?
I would make a politically correct statement here. What I'm actually seeing in India is that one of the things about India is that you have a very large ecosystem, right, in terms of human capital, right, and that enables to create companies like L&T, KEC, and so on. So what I've realized in the last 10 years is that since they have that ecosystem, and Indians are super focused on cost, right? So you have size, you have people, you have talent, and you have a super low-cost ecosystem, right? And that's something I do not see in any other emerging market other than China, right? And therefore, whatever solutions that we put across are certainly implementable in South America and Africa and so on and so forth. Clearly, all these companies that we have built in India, right, which are focused on cost and essentially on scale, These guys have met with phenomenal success, right? If you now look at L&T's order book today, right, it's substantial amount of it is coming from Middle East and Africa and so on and so forth. Same is true of KEC, same is true of a lot of other companies. So I think India is a great training ground because it gives you scale and also makes you super value conscious. So I think India is probably the best training ground for companies to kind of start off because you can build something here.
But do you think founders here are very risk averse? Just as generally, that's how India has been. We're not willing to push the boundaries and take the kind of risks that other markets have been able to. And maybe we don't have the capital base and why we need more capital flowing in. But do you feel that risk averseness there?
I mean, so India is sort of a dog-eat-dog market, right? I mean, end of the day, I mean, the sector there are fair amount of margins to be made. What does happen over a period of time, the margins completely collapse, right? It comes down to absolutely bare bones. And then companies are forced to look out, right? For example, one of the companies that I've invested in South Africa is using Sterling Wilson, right? And when you speak to them, they say that we are really struggling to kind of make our margins in India, right? So the problem is excessive competition, right? Actually drives these companies to go across. So I don't think it's really a question of risk appetite per se. It's just that most of these companies are being forced to expand outside, just to get better margins.
And do you think we can do more by way of cross-border investments, partnerships, just to make this actually happen in reality? Sterling Wilson is a great example, but they're a very large organization, very easy for them to do it. But the new startups on the ground, much harder for them to do it. So what can investors do to really help that movement happen?
So I don't know how implementable our solutions are in the West, right? In Europe or in US, right? I frankly struggle. We can export something to them, but I'm not sure. I mean, our solutions really stack up there, right? But I do think in other emerging markets, we do have a fairly decent chance of making it. But here is the challenge. I don't see too many Indian startups actually working in South America and so on because there is a local nuance, right? And to essentially build that liaison with the government to hire local people, you need to put some amount of capital inside. So you require fairly large companies which have that patient capital to invest 2 years to make those supernormal margins. So I do think that larger companies from India, right, clearly have a much bigger advantage. I mean, Bajaj has been exporting for the last 30 years, right? I mean, so if you go to Sri Lanka, right, every second bike is a Bajaj bike. But the reason for that is because Bajaj are investing back in the day of Rahul Bajaj in the early 90s. So that franchise has been created because they had capital, they had the time to build it out.
So I think just to add to that, this is actually a space where LPs can also help their GPs and the companies they're in to, whether it's a South-South initiative or any sort of Indian companies going to Africa, for example. We've also seen instances where some of our, for example, microfinance companies in Egypt are actually speaking to some of our GPs here in India because the market is just more advanced in India to almost do some lessons learned or kind of chart the way for the future, which they can implement in Egypt, for example. So I think there is a lot of opportunity, and this is something for GPs to also kind of extract out of their LPs, which is what I always encourage, that you have a wealth of, contacts, I would say, and networks where we can actually make introductions to the right players in the right markets for expansion for your companies. And I think this is something which is not very well used, but can be used a lot more by our companies, investees, and also our GPs.
I think let's have a little realistic view around this whole South-South and everything. South-South has been a topic for IFC to push ever since I joined. I'm talking 97. And we must have done tens of reports on this to push it. India, Africa, India this, India, Nigeria, and all that. Despite all that, it's been systematically just a blip. And why is that? And if you see service exports, yes, that's happening. If you see manufacturing you have done in India exporting, that's happening. But real risk capital putting in another company, very little. And let's face it, if you are an Indian sponsor and you can't manufacture in India, where you know the ecosystem well, manufacturing in another country, it's great, but you'll be careful, super careful. And the current geopolitics doesn't help also. The whole geopolitical situation and the trade are forcing a lot of companies who are planning to set up shops outside to do a rethink. What tomorrow if some things change? Will we meet with standard assets? So I think construction, EPC, services where not risk capital is not put outside will continue to happen. But where risk capital has to be put, that's something where sponsors, and rightly so, are seriously thinking.
And that brings me to blended finance, right? So just blended finance in general. We've all talked about it. It's been talked about for the last 10 years from whenever the word was coined. How much of it has actually been done? Very little. And maybe it's not been done because structures have been difficult, outcomes are hard to actually establish. But what's your view on blended finance?
So, so my view on blended finance is it's important, but it's not the panacea for everything. Obviously not. The amount of concessional capital available is finite. That's number one. Second, if you have concessional capital, people think you can just give somebody a grant. The fiduciary responsibility of whoever is giving that grant is even higher than if you are giving commercial capital. They want to see the impact on the ground. There are a number of rules on pure concessional blended finance, which people mostly don't know. They just think it's a tool, just put it in and things will happen. There are 3-4 rules that, and IFC has been a custodian of a lot of donors for blended finance. In fact, we are probably the largest custodian on blended finance across the globe. The 3-4 rules are, number one, donors want to see minimum concessionality, which means put only that much amount of concessionality as the project needs. Don't put more than it's necessary, because that creates wrong incentives in the project. The second is there should be no market distortion. So if there are 3-4 projects, if you give one project in the same space, blended finance, and the other 3 you don't, and the other 3 are able to compete in the market, you create a distortion. You don't want to see a distortion. Maybe you do it in the first of its kind project, which creates new markets around it. The third very important one, which is the missing link in all this, is the road to sustainability. Why would you give concessional finance to a project if the project remains a one-off project forever? There's no point. You've given $10 million, you've exhausted it, there's no replenishment, and the project never replicates. So you want to give that money in the hope that while that project is being done, you are creating an enabling environment, policy, regulation, markets, etc., so that the second project will need lesser blended finance, and the third may not need a blended finance. So that's called the road to sustainability. Unless you tie in whatever blended finance you do with a clear road to sustainability, it's futile in my view. So that's my strong view on this.
No, thanks for that, and I completely agree with what you're saying. And Arvind, you had touched upon, different ways in being able to accelerate climate, especially in a country like India. Maybe you need a different type of fund structure. So just any thoughts that you have to share around that, so we can find ways for those early stage innovations to actually see the light of day.
Yeah, so first on blended finance, I think as far as the PE spectrum of climate is concerned, for us, we see that there can be a catalytic effect if blended finance structures are put in right now, so that path to sustainability is built out. Because in climate, what we don't have is a full cycle, including exit track record, right? Like what microfinance and other financial services companies have in India. So that's where we think that blended finance does have a role to play. In terms of the other gaps that we spoke about, see, the 2 things that we've been exploring and investigating, but these are very difficult to pull off, is at the lower end of the where you have the incubation side in the very early stage of the businesses, to look at more perpetual vehicles, which can be your venture builders effectively, where you keep recycling capital basically with your winners. I think those type of structures need to exist so that you can keep fostering innovation. You can also keep failing, but the successful models can then literally go on that into the next steps, basically, towards venture capital and towards other forms of capital to scale and grow, like in a factory, So you keep doing prototypes. Whatever fails, but whatever succeeds can then be pushed down to the next side. On the deep tech, elements, which I think India also needs. I keep questioning whether a 10+1+1 structure will actually work in India or not. And the challenge that we are seeing is that even the fund managers who are investing, sometimes they aren't sure. And then this whole issue of having your ghost funds with 1 or 2 or 3 of these assets which are lying at the end of 12 years gets created. And that's something that, coming from a DFI myself, we are very allergic to it now. So one of the things that we've been looking into is, can we extend vehicles or create secondary vehicles which can take some of these assets, which are maturing in the life cycle of a regular fund and park them or have a follow-on sort of a life through a differentiated secondary fund. And I've not seen a lot of that development happening, although at an initial stage now some secondary funds are starting to come up. But I think climate is about 5 to 7 years away in any case, because we are at a very early stage in the life cycle of where climate investments are in India. But I think that's going to be important for us to at least do some groundwork on, so that capital doesn't get stuck. Because if you can't show DPIs, and that's the one thing that I keep looking at now, I don't care about IRRs, I only care about DPIs. If we don't see that, then new capital flows are not going to happen.
Thanks for being so candid. An evergreen fund is a GP's dream, right? It just does not happen. We all love talking about it. We all wish it could happen, but it just doesn't. So what's the middle ground, Shalabh? How do we make this work for LPs and GPs?
No, first on deep tech. So I'll just give an anecdote. I'll just remember when 10 years ago, I used to meet any company or startup or fund. What are you doing? We are using AI to do this. AI had become like a word that, this will sell. And when you scratch the surface, and again, Kaushik knows it, we've been in meetings together on this, they were just using an Excel spreadsheet with some regression and correlation and calling it AI. Today, when I talk to a lot of machine learning and then deep learning came and so on, let's be very realistic about the founders and startups in India, how much deep tech they really are doing. Then I talked to a lot of VC funds here who focused on deep tech, and I asked them, what are the deep tech companies you are supporting? 3 out of 10 may be real deep tech, which are R&D ties, where you need government R&D support to actually help them, because there's no return, there's no valley culture here. So you need some sort of government R&D philanthropic support to support real deep tech. The other is not really deep tech. It's still applications, it's still copying what has been successful in models somewhere else and doing it. So again, let's take a very pragmatic view on all this. Let's not make a catch-all, deep tech, all that. A lot of the revolution that will come now will be in the AI application space. That's not deep tech. The moat there will be data, distribution, many other things, but not deep tech. The models and the infrastructure layer has already been done somewhere else. We have a couple of companies in India who are trying to build large language models based on the vernacular languages here. That's deep tech if they succeed, but the rest is all application layer. And there India has a strength. A lot of startups will mushroom and a lot of people will do that. So we would definitely support VC funds there, whether it's on climate, non-climate, etc. Doing this, having a realistic view around it. I know, Kaushik, you may have more views on this.
Yeah, so I have a bit of a contrarian viewpoint. I really don't think VCs, or at least climate VCs, which have $50, $100 million, should be doing deep tech. So deep tech is a game for 5, 7, 10 years, right? It essentially should be large corporations like Reliance and L&T and so on, which have that capital to sit on and invest, and and they have the distribution to play on, right? So I personally don't think climate VC should be touching deep tech, the barge pole. I think it's a waste of LP's money, to be honest. And I think they should focus on more commercialization, less on deep tech and research and so on and so forth, so that does not become another university project.
I agree. We are on the same page.
So you guys just killed my hope of an evergreen fund. We'll open up to questions in just a minute. So last question before we do that, because I think everyone's itching to ask a lot more difficult questions than I am. But what is the one structural element you think needs to be changed in India to really accelerate both capital and innovation? from your experience? And this is for all of you.
For generally for funds or generally for what? I think the ecosystem exists. Basically, I mean, I'll give a very standard response. Whatever, there has to be policy stability. Whatever you've got certain policies and environment, don't reverse any of that. Should be only progressing from there. The rest is all very granular. We can get into the details of why secondaries are not happening. Maybe this needs tinkering. Maybe SEBI should allow something there. Maybe RBI should allow something there. We have to do, we want to get foreign investors here under an IFC program called the B loan program. That's not allowed by the government. So I don't want to get into a large laundry list of that, but if I package all of this together, I think it's just policy stability, no reversal of policy. If you've got a policy direction, stay with it. Maybe you can give a policy direction vision statement that this is what we want to see in the next 8-10 years, and then the little reforms can happen in that 8-10 years. That will help.
I think totally agree with Shalabh on that. And I think the only thing I'd add is we've talked about blended structures. And what I find is lack of domestic capital in junior tranches. And I think if domestic capital and domestic institutions can actually fill that gap, it'll actually help commercial investment to come into, difficult places, difficult structures. But yeah, that's what I think.
Do you mind repeating the question? I missed the question completely.
No, just structural change in India to mobilize more capital.
See, I think India is a fairly narrow market, right? And the core issue is that, I mean, if you look at on the climate space, right? Apart from renewables, manufacturing of modules, now batteries, and EVs, right? I mean, have you seen any major investments in water, waste, and so on and so forth, right, on the municipal side? I mean, there is a serious lack of capacity at the municipal level, right? The thing is, you have very good, capacity at the central level, slightly less at the state, and suddenly it just falls off, and you are nothing at the municipal level, right? So, and therefore, if you want to kind of, if you really want to expand the climate pie, right, you need to build capacity, and this is not something that we can resolve here. This is something the government needs to do, essentially build the capacity at the municipality level for all these other subsectors to take off. Right? Currently, these sectors are not really investable in that sense at this point of time.
Nothing else to add. I think let's open it up for the audience as well.
Super. Go ahead. Can someone pass a mic?
I have a couple of questions, if you don't mind. I'm part of a thematic fund which only focuses on climate. And my first question is that through a fund that was investing into India in climate out of India, we've now decided to kind of start a fund that's India domiciled through an AIF structure. But when we go to a DFI and we demonstrate our track record, our DPI numbers, our basically the kind of quality of companies that we've invested in, the response has always been, you're great, you've done very well, but we're over-allocated to India and we're over-allocated to climate. So, and yet there is a view that there's not enough being done in climate. So one is, how do you get past somebody who says that to you when you've actually created all the elements for a thematic fund that has done well, and you still shunned because there's just no capital to allocate, and you got to wait till we can actually allocate more capital to climate? So that was one question. And then the second question, and I want to basically address Kaushik's issue particularly. Obviously you guys have access to investors all over the world, and the world is your oyster. So in order for me to actually generate outsized asymmetric returns for you as a venture capitalist, I have to take those science bets, because those science bets that you're talking about that I shouldn't be taking, which are long-tailed, have the ability to give you outsized returns. Strategically, what we've been doing, therefore, is trying to return capital to investors as soon as we can on the non-science bet of things, so that we can actually sit through the balance of your capital returns once we've actually returned back to you what your initial capital is. and then allow those science bets to work or not work for you. And if you have about 10 or 11 of them and you even get one right, there's a potential for outsized returns. But then at that point in time, you're willing to wait through that because you've already got your capital back. So just an observation that's how we're trying to address the issue of the deep tech end of the investments that we're doing. Just
Maybe I'll respond to the second question. So the thing is, that's my view, right? So the thing is, it's my view that climate VC should not be investing in deep tech, right? The reason is that there is very little anecdotal evidence that this has worked, right? And that's the fundamental reason. I'm completely basing it on the facts that I haven't really seen, right, too many deep tech startups on the climate side, right, making a lot of money, right, through the investments that VCs have made. So that's a limited point.
Maybe Shalabh, and maybe you can have that conversation sort of post this, but Shalabh or Nishtha, if you guys want to answer the first one.
So on this, we have seen structures where, let's say there's a fund, right? We get some concessional capital or other capital as for technical assistance or for R&D program. But that's separate from the commercial return that LPs are looking for in the fund itself. So we can do it through this tier 2 structure. All blended in the fund structure, I don't think it's going to fly with most DFIs because they want you to invest in proven technologies and commercial ventures. Of course, there could be a long tail, all that could be more used for market development and other things, but not to prove a technology. That wouldn't fly in this structure.
Yeah, so I think it's a very real problem and there isn't a simple solution to it. I think all of our organizations have allocated budgets, India allocations, which are slim, becoming slimmer, honestly, for a lot of them. But I think what's key is, and there are a couple of reasons for this also, because if we have a very limited budget and we have existing relationships which are doing really well, it takes a lot for an organization, particularly DFIs, to give that existing relationship up, which is doing well, and to invest into a new manager. But saying that, I would encourage, keep the conversations going, because given vintages and given the re-ups happening, there could be, certain years where we actually have budgets where, we could invest in new GPs. Not saying that we don't do that at all, we do, but I think each organization is different and special and their mandates change, etc. So I think it is difficult and it's frustrating. I totally understand that for all GPs, but I think keeping conversations going is the only way to do it.
So on the ground, IFC faces the same challenges as Nithya is saying, so I don't have anything more to add on that. But a solution can be by working through fund-of-fund structures. There could be a manager specifically for India where the job is to invest in a number of funds, and the DFIs come in and incubate that fund-of-fund structure, whether it's an IGIF, which has a fund-of-fund, or any other. That's the vehicle that should come in so that the DFI money is used much better, as opposed to going transaction by transaction, fund by fund and all that, and then say, we are up. That's not the way to do it. I'm not saying it's happening right now, but that's what I have proposed to our colleagues.
Again, maybe that happens, I don't know.
Sorry?
I don't know if all organizations will be able to do a fund-of-fund also. So I think it's very specific. I'm not sure about ours, but if it works, I completely agree. I think that gives a lot of exposure. Yeah.
Yes. Can we get a mic there, please?
First of all, congratulations to all the speakers and the moderator for an excellent panel discussion. I have one observation, one question for Shalabh. Shalabh, your title says you're South Asia Regional Head. So my question to you is, what exactly is IFC doing and the other funds doing, LPs are doing in Nepal, which is our neighboring country? And the second is to Kaushik. I think you made a very nice comment where you said that we cannot risk LP capital going into deep tech and those sorts of areas because the returns are not proven. But don't you think that government capital can marry with your capital can be married with your capital to fund deep tech research. Because if you look at the US, even Google, there were little young boys in Stanford who got some seed capital and they made Google, right? So government capital coming in, supporting you, just a thought.
Maybe start with your question, right? So end of the day, I mean, it's hard to compare the Indian ecosystem with the US ecosystem, right? I mean, just to give you perspective, right? The VC funding at University of Pennsylvania, right, is bigger than the entire VC funding in Germany, right? So the ecosystem in US, right, for risk, right, is a different scale altogether, right? Which does not exist anywhere in the world. I mean, what US has is very unique, right, very specific to the US, and also because they're a head start, and also because they take much more risk. I don't think that ecosystem is there in India at this point of time, right, to offer those kind of solutions, right? But what I do think is that more than the government, right, I do think that it is incumbent on the organizations, on large organizations, to do that research, right? I don't think it's a fund-based thing. It is something the organizations need to do, right, in collaboration with the government. It's not a VC space. That's my limited point here.
So on Nepal, as you may know, Arvind, in your earlier organization also, we partnered with them to do a large hydro in Nepal, which is called the UT1 hydro. And it's been a pretty difficult journey with all sorts of environment, social, all these issues and so on. Nepal is a focus country. It's part of our South Asia, so we're really focused on helping them on the ground. The key focus areas remain SMEs for job creation, which we are doing by lending through local banks. So Nepal Rashtriya Bank, NRB, is one of them. We are lending to them and on lending it for SMEs and so on. Tourism has been a big focus area for us for a long time because Nepal has natural strengths in tourism, but the lacking part there was the integrated infrastructure related to tourism, whether it's airports, airlines, connectivity and all that. So we are working on upstream projects and advisory projects to make sure that tourism is ramped up. I see our colleague in JICA who's also been involved on the UT1 hydro side, and maybe you want to add to the Nepal story.
Hello. So we have our good friends at Dolma that we supported in their first fund. Again, Nepal has gone through quite a lot of shifts, whether it's on the regulatory side, the political side, and the one struggle that I have is that capital coming out of Nepal, those stories I think need to be articulated more. We need to create more instances of that. And if that happens, then naturally, we are focused on SME development, right? So we'll be happy to then, move fresh capital. And that goes to your question as well. We actually like to support first-time managers. So I'm happy to have a conversation with you. But for anyone who's raised fund 2, fund 3, we keep talking about return the capital back and then we can recycle it back, right? So that's the guiding principle that we work with.
Thank you so much. I can see the IIC team waving flags that we're at time, so we're going to have to take a pause. But I think the team's available for questions, I hope, during lunch. And Ranjana, maybe we can take some of the feedback that was given on things that could be done and some things maybe IIC can work on. So we'll try to do what we can, at least as the council as well. So thank you all for joining us and being patient before lunch.
Thank you to the panelists for being so candid, thoughtful, and conversation-stirring thoughts you have presented. Thanks a lot. And now we can move for lunch. That is outside in that garden. And we reconvene sharp at 2:15. So kindly be on time.